The kind of model that we ran was basically looking back to 1999, which is when all ISAs were launched, and basically sort of assuming that you put £3,000 in each year. Looking at two examples of two different people who every single year they've just invested on the same day, either the first day of the tax year or the last day of the tax year. So they've invested the same amount since 1999. The early bird ISA investor would be around.
Hello all, and a very warm welcome to the Steps to Investing podcast in partnership with Asset Value Investors. In today's pod, as we begin the new tax year, we're going to focus on the benefits of being an early bird investor. Yes, there are lots of things to consider, including new tax allowances, the importance of using your ISA wrapper, the impact of different investing approaches on your long-term returns, and why you need to remain invested even in the darkest days of the stock market. To help us contemplate these things, I have the cream of the industry's investment expertise on the pod. From one of the UK's largest investing platforms, AJ Bell, we have its head of investment analysis, Laith Khalaf, as well as renowned investment journalist and ISA investor, Cherry Reynard. Cherry and Laith, welcome.
Thank you, Marcus. Thank you for that introduction.
Yes, thank you.
Laith, let's start with you by, framing where we are in the year. What do we mean by, this? We've got this fresh tax year and we've got these fresh contributions for our ISAs. What do we mean by this?
Yeah, so the tax year runs from 6th of April to 5th of April each year. So you've got a new tax year that's just started. That probably means a lot of people have actually a lot of them done their ISA allowance for the previous tax year. And so 6th of April rolls around. It basically starts a whole new tax year in terms of the income tax that you pay, capital gains tax you pay, but it also means you get fresh new allowances for pensions and ISAs, which of course we're talking about today. So your ISA tank is now empty again and you get to fill it up. And the amount you can put in is £20,000, of which 4,000 is your lifetime ISA allowance, which you can take out if you're a younger ISA investor. So basically it's kind of a fresh start. You can add to your ISA all the way through this year. The 5th of April is the deadline for this tax year. So the 5th of April 2024 is the last day you can contribute to an ISA for this tax year, but you can do it at any time of the year, even though most people leave it to the last minute.
Okay, and why has this year in particular been important?
Well, I think, if you're into saving tax, it's really important because we're all going to be paying more tax, or almost everybody's going to be paying more tax this year because of, decisions that the government has taken over the last couple of years. So the first thing is that, the government has frozen income tax thresholds. So the rate at which you start to pay income tax has been frozen at £12,570 a year. The rate at which you pay higher rate income tax is frozen at £50,270. And those bands are now frozen until 2028. So if you think about what that means that kind of as you hopefully keep earning more, actually tax bands aren't keeping up with your earnings and you're just actually paying more and more tax on your earnings and potentially also moving into a higher tax bracket as well. So, in 5 years' time, we're gonna have a lot more higher rate taxpayers than we do at the moment. You've also had the additional rate tax threshold, which is the point at which you start paying 45% income tax. That's now been cut to £125,140. So that's been cut from 150k. So again, more tax for higher earners. And there's actually even a 60% tax band in between £100,000 and £125,000, because at that point you're paying 40% tax, but you also start losing your personal tax-free allowance as well. So it's all pretty nasty and pretty complicated. And that's the income tax side of things. There's also other things specifically with investments which are happening as well. So we've had the dividend allowance, which is the amount of dividends that you can receive tax-free each year, has been cut from £2,000 to £1,000 this year, and it's going down to £500 next year. So again, a lot more people are going to be paying dividend tax if they don't have their investments in a tax shelter. And capital gains tax as well. Last year, you were able to make gains each year of £12,300. That's actually being cut to £6,000 this year, and is going to be cut to £3,000 next year. So, a whole host of, additional tax that people are going to be paying, on their investments and on their income. And clearly a good way to actually mitigate that is to use tax shelters like SIPs and ISAs to protect your investments from income and capital gains tax.
Yeah, really interesting stuff. I was actually looking at some figures from AJ Bell, and with the dividend changes alone, it's going to affect millions of Brits potentially. So it will definitely have a big impact on small shareholders, business owners, people like that. Okay, and then just, around this tax year end, do retail investors tend to trade a lot around this time of year?
Well, I mean, there's definitely a lot of activity, mainly around, to be honest, the end of the tax year. I think it's no secret that that's when, for whatever reason, people do their SIPs and their ISAs. I guess the deadline is just really motivating. People do just tend to leave it to the last minute. So the last couple of months of the tax year always the most busy in terms of people actually putting money into their ISAs. I think, at the beginning of a new tax year, you've got kind of a cluster of very hardcore early bird ISA investors who are there on 6th of April, ready with their debit card to put their allowance in. But I think they're probably the exception rather than the rule. So I mean, that's in terms of, I guess, active, ISA activity. In terms of trading activity, like share trading activity, actually, that the spikes that you see in that actually tend to be driven by more market orientated events. So just looking back over the last few years, stuff like the Brexit vote, obviously when COVID hit and we started having lockdowns, and when the vaccine was announced as well, all of those things, that is what tends to actually stimulate trading activity, because the rest of the year everyone tends to kind of be spread out a little bit in when they're kind of looking at their portfolio or making changes, for instance.
Yeah, I think it may have been one of your competitors, so I won't mention who it was, but I was looking at some figures, and I think it was like the record for using up your contributions the fastest in a year. And I think by 1:07 in the morning, so just after the midnight deadline, they were 1 hour and 7 minutes into their new tax year, and they'd already used up their entire £20,000 contribution. So that was a record there, I think. Okay, Cherry, do you want to let's chat to you about ISAs? Have you been using these fantastic tax wrappers for a long time?
Yes, I have. Basically, my sort of journey with ISAs, if you like, was I started investing in the middle of the tech boom of the late 1990s, and having made some really kind of disastrous tech investments that sort of went to zero and were just hopeless. I thought, well, I've really got to get a grip of this, and made my first proper sort of ISA investments in a collective fund run by a sort of famous fund manager called Anthony Bolton-Norrie, who used to be famous. And that proved a lot more productive and for my long-term wealth than any of the tech investments I've made. And I've invested pretty consistently in ISAs ever since. And now I put regular savings in them. I have junior ISAs for my children. And of course, like everybody, I wish I started sooner and I wish I put more in, but there's always something to spend money on. There you go.
And why do you think they are so important to use?
In a way, I feel it's almost not that they're sort of so important. It's almost like, why not? You can put pretty much any very esoteric investments. You can put almost anything you like in them. It doesn't cost you anything. It shelters everything from tax, and it's almost well, why wouldn't you? So I mean, I personally I like using them because you can build up a kind of long-term income stream. So and that's sheltered from tax, and so that sort of protects you from, whatever the latest government changes in the tax rates are, or changes in the dividends and that kind of thing. But there are lots of other uses for them, and you can really shape them to your investment goals and objectives, and really get the flavour of ISA that you like.
Yeah, so it's this really important thing where there's no taxes on capital gains, there's no taxes on dividends, there's no taxes from interest on bonds. All of that is just ignored. You don't even need to tell the taxman about them. So this is why it just makes investing so easy. And of course, against the context of what Laith describes there, and in how our tax-free allowances for these things, specifically with investing, have come down, and they're going to come down again, then we really need to be utilising them.
Yes, and I think, it's also worth mentioning that they're hugely flexible. In a way, it's not always an advantage to be able to take money out of an investment, but you can for emergencies. So it's not like you're sort of locking everything away, which I think is possibly more of a psychological advantage than a real advantage. But also, my understanding is that ISAs are kind of increasingly flexible in the way you can use the allowance every year. So, yeah, that's worth noting as well.
Laith, as investors, we can wait till the end of the tax year to invest. As you say, the end of this tax year will be April 5th in 2024. Or we can get in there early, as in right now, and sort of get going on this. Now, you've run some numbers on how this impacts our long-term returns. So which approach wins?
Yeah, so the kind of model that we ran was basically looking back to 1999, which is when all ISAs were launched, and basically sort of assuming that you put £3,000 in each year. So you can do that either on the very first day of the tax year, or on the very last day of the tax year, and you do that every year. So actually, looking at two examples of two different people who'd every single year they've just invested on the same day, either the first day of the tax year or the last day of the tax year. So they've invested the same amount, since 1999, the early bird ISA investor would be around £9,000 ahead of the late bird. So if you think they've contributed the same amount and it's £3,000 each year, that's basically the equivalent of an extra sort of 3 years of ISA contributions. And 1999 was the height of the tech boom, which, as Cherry mentioned, it was actually a really good year for the stock market. So actually, the early bird ISA investor in that year puts their money in, and then by the time the late bird comes along, they're already a long way ahead, and that's given them a really good head start. But what's quite interesting is that even if you look at years where that hasn't happened, where actually the opposite has happened, like this financial crisis in kind of 2008, kind of your early bird there, if you put your money in, if that's when you started, your early bird would see their money fall by 20% by the time that the late bird starts to put their money in. But actually over time that recovers, and actually by the present day, that early bird ISA investor kind of putting their money in on the first day of each tax year would now still be £6,000 ahead. So it still kind of pays to get your ISA allowance in early if you're a long-term investor.
Okay, and what's the force that's driving this? Why is this the case?
It's just market compound growth, really, because kind of even if you don't have a good first year in the market, that contribution still then goes on to grow. If you looked over shorter time frames, then there would be some occasions when it would be paid to be a late bird investor, but would you have rather have a bigger pot in the short term or the long term? Obviously the kind of answer is pretty straightforward. So it's just simply the effect of having your money in that market, the money in the market for that bit longer.
And Cherry, how would you say compounding has played a part in your returns over the years?
I think it's vital. It's almost it's very difficult to disaggregate it and sort of put a figure on how much comes from contributions and how much comes from sort of compounding and growth and that sort of thing. But I'd say possibly as much as half of my current ISA portfolio is from growth, not contributions. And that's not by investing in sort of hugely risky assets or something. That's just the grind higher of investing regularly and that sort of thing. I would add that, again, income helps in that. So if you reinvest dividends over time, then, they're added to your portfolio, you're buying more units, and your portfolio grows that way. So that's a sort of a nice way to compound your returns as well.
Why do we need to be invested when the markets are down? Obviously this year, last year in particular was a really poor year for markets, and they're still very volatile now. Why do we need to be invested when they're down?
It is honestly one of the most sort of perverse things about human psychology, I think, that everybody, if you were buying shoes or clothes or that sort of thing, and you saw something on sale, you would immediately go, oh, what a great bargain. But the moment stock markets are down, everyone's, oh, no, something that the world must know something that I don't, and I have to ship out, and, and so nobody buys, even though people know the theory of you buy low and you sell high, everyone gets terribly nervous. So actually, now, low markets are exactly when you should be looking hardest. Because you can pick up, because inevitably when stock market sentiment is poor, the baby is thrown out with bathwater, and you tend to get very good companies that are thrown out along with ones that, where there are problems. And, good fund managers should be able to sort of pick those out for you. So I would say now is exactly the sort of time that you should be looking at stock markets. Though I would say that if you're going into stock market investment, you do need to have you do need to develop a slightly thicker skin. Markets do bounce around, and they will bounce around on really things that don't matter. At the moment, they're very obsessed with what the Fed is going to do next and that kind of thing. And it probably doesn't matter for most companies, but it just affects sentiment in the market. So you always need to be prepared for a bit of, ups and downs. But there are plenty of ways to mitigate that. You can mitigate it through diversification, through investing regularly, all these kind of things.
And am I right in saying, Cherry, that the best days actually often follow the worst days?
Yeah, there's lots of really good evidence that shows that missing just a handful of days in markets can really hurt your long-term returns. But also, those best days often come really quickly after the worst days. So there was a recent study by JP Morgan, its long-term capital markets assumption study, which showed that missing the best 10 days in markets over 20 years reduced an investor's annualized return from 9.7% to 5.6%. And those best days, 7 of those 10 best days occurred within 15 days of the 10 worst days.
Right. Okay.
So the message is, it's complicated, but stay invested is the big takeaway.
Laith, now we looked at this sort of binary approach, I suppose, of very early or very late, but there are different ways of doing it. We could devise a monthly investing plan. And again, you've run the numbers on looking at just chucking in lump sums versus monthly investing and spreading it out. Which is better and why?
Yeah, so I mean, again, it depends. Well, it depends, I guess, what you mean by better. If you mean in terms of like the actual size of the pot that you get at the end of the day, which I guess is what a lot of people would mean by it, then, having your money in the market for longer generally works out better. So again, if you look over the last 20 years, if you'd invested a £20,000 lump sum 20 years ago, it would now be worth around £118,000. If instead you'd have chosen to kind of regularly invest that same amount every month for that same period, it would be around £70,000. So quite a big difference there. Again, we happen to be at a very strange sort of place right now. Well, it's not that strange, but it happens every now and again. But 20 years ago happens to coincide with the low in the bear market of 2003. So it was actually like, an amazing time to be investing, kind of like as Cherry was just saying, kind of like investor confidence was absolutely on the floor. Stock markets were really cheap. And so actually since then there's been an absolute, kind of bull market, if you take away the 2008-09, share prices have gone up massively over that period. So again, if you run the analysis, again, looking in a less auspicious time to be investing. So if you put your £20,000 in October 2007, so just before the financial crash, you'd have around £58,000 today. That's partly because it's not such a good time to be investing, but also you haven't been investing for as long as well. So if you compare that with what you might have from a regular savings plan, then it would be around £54,000 from a regular savings plan of the same amount. So there's actually, that's quite, that's a relatively tight difference, depending on the kind of timing of your lump sum investment. And I think, and that's the thing with kind of lump sums, is that kind of if you're putting a big amount of money into the market, actually what happens over that first kind of 12 months actually does actually matter compared to a regular savings plan where you're kind of just drip feeding it in.
What would you say are the key advantages of using a monthly savings approach?
I mean, probably the biggest advantage is that it kind of smooths out the volatility in the stock market. So you've got money going in regularly, so you don't get these very big falls in the value of your investments. So that's a positive thing, particularly if that's something that concerns you. I think there's also a question of affordability, isn't there? Because it's all very well talking about lump sum investment. If you don't have a lump sum to invest, well, it's kind of academic, isn't it? So for a lot of us, actually, regular savings make a lot more sense in terms of, you can pay them out of your income. So you can set aside a certain amount each month and it just goes into the market automatically. And that's another thing, is that it kind of, because it happens automatically, it just takes the hassle out of investing. It also kind of imposes a savings discipline on you, doesn't it? Because it's kind of going out automatically rather than kind of thinking, oh, how much, kind of every year, how much do I need to put aside? And then maybe not doing that, maybe missing your ISA allowance or kind of, not kind of missing a few years of contributions, which can really stack up at the end of the day. So, I think for most people, it seems to me that actually a regular savings plan is probably the best way to go about it. And if you happen to have sort of extra cash available, then do lump sums on top of it.
Okay. I'm going to get into the final bit of our interview, and that's just having a little think about investments and how we kind of approach this. Now, Laith, for the early bird who maybe wants to get going with investing, but we were talking about volatile markets and they don't want too many sleepless nights. How would you approach investing in your ISA in order to kind of reduce some of those worries a little bit?
Yeah, so I mean, I guess the thing I'd probably point out is, I mean, we've just been talking there about kind of regular savings versus lump sum. We tend to think of, putting an early bird contribution in as a kind of lump sum investment, which technically it is. But, if you're doing your ISA every year, you're still a regular saver, right? Even if you're putting lump sums in, you're still a regular saver because you're just putting it in every year rather than monthly. So there's definitely, even if you're doing that, there's definitely a smoothing effect that you get from doing that. Rather than kind of just putting all your chips on the table in one go, you're kind of slowly dotting them through your kind of entire savings journey. Beyond that, if you're looking to kind of dial down risk, then what you need to be looking at is reducing your exposure to shares, to the stock market. And you would do that by adding in other investments, things like bonds, property, perhaps absolute return funds, cash, possibly infrastructure, all these other various asset classes that you might look at, probably bonds and cash probably being the main ones. So either you can do that yourself, running a kind of portfolio of shares and bonds, which is tailored to your own sort of personal risk sort of circumstances. Or you can buy a couple of multi-asset funds. So those are funds run by professional fund managers. So they invest in a whole gamut of different assets to give you kind of diversification across a lot of different markets, and a lot of them are run with a certain sort of risk profile in mind, often quite low risk, and so you can pick one out that kind of sort of fits your own kind of attitude to risk. I mean, the thing I would point out is that if you are, that it's absolutely fine to take a more conservative approach with your investments. Over the long term, that is probably going to mean that you get lower returns than someone who is taking a full equity approach over the long term. But the flip side of that is that actually you get lower volatility over the short term. And for instance, if you might need your money, you're never going to have to sell out when the market's absolutely on its knees and you're making big losses.
Okay, so would you say that if you've got long time frames, and I'm sort of saying, I mean, they say a minimum of 5 years for equities, but for shares, but 10 years or longer than that if you're considering about really wanting to maximize long-term returns, then taking an equity approach, a shares approach is quite a good idea?
I think, yeah, I mean, from a return perspective, just looking at the numbers, then that's the case. Yeah, I think if you're probably in that 5 to 10 year gap, then probably a more conservative approach is warranted. Anything over that, 10 years, I think kind of you can say happily have a full equity approach. I think it's often kind of, particularly within pensions, that people often think that kind of pensions have to be this really safe asset, and kind of even kind of people in their 20s and 30s can think that, but you can't get hold of your pension till you're 57. You might not get hold of it till you're 65. You've got 40 years, and I just think particularly people with that long, really should be trying to focus on kind of equity investment. As I say, kind of like over the long term, the numbers show that equities are, on average, the best returning asset class, but there are a range of outcomes, and it's not just about the numbers. It's also about kind of, investing in something that you feel comfortable with. So, if it's going to cause you sleepless nights, then definitely don't be investing in the equity market, but just be aware that actually kind of long-term returns are probably going to be better the more risk you take. That's just the trade-off.
Cherry, have you favoured any types of investments over the years? And I suppose by this I mean sort of broad things like, vehicles like investment trusts, for example.
Yes, I think I'd probably go through phases. So I mean, I've definitely favoured equity income. I find there's something very reassuring about getting, 4 or 5% of your money back every year in dividends that goes into your that is reinvested in the pot. And I think that's quite reassuring, particularly in volatile markets. I do like investment trusts. I like the fact that you can if you look carefully, you can get investment trusts that are trading below the value of their underlying assets, that trade at a discount. And particularly when sentiment is weak towards a particular asset class, you can go and sort of cherry pick in those. More recently, I have sort of looked to get a bit more of a sustainable flavour in my ISA. So, as I said, investing in some of the energy infrastructure, renewable trusts, and they also pay a nice dividend as well. So, but I like the fact that they've sort of got, the dual objective of, well, if I don't make money, at least I've done something nice for the environment. But hopefully you get both.
Laith, I just wanted to ask your opinion on investment trusts, actually. Is this something that you think is a good vehicle for retail investors?
It can be, yeah. I think, actually, if you look at whether open-ended funds or investment trusts, actually, if you've got, a similar portfolio, you're going to kind of get similar returns. So actually, probably for me, the choice is not between investment trust or unit trust. Actually, it's about kind of the fund that you're choosing, how much risk you're taking, and the fund manager as well. So, kind of if you've got a fund manager who's not very good, whether they're running an investment trust or a unit trust, guess what? Your returns aren't going to be great. I mean, investment trusts, I think, are probably a little bit more complicated and risky than unit trusts. So you have the kind of discount, the investment trust can trade at a discount or a premium. So that adds a little bit of complexity. And they also can borrow to invest. That's actually quite good over the long term, generally speaking, because if you borrow money to invest it and the market goes up, which it does over longer time frames, then actually you get even more returns. But both of those things also mean that investment trusts can be more volatile, but they are still really interesting. Lots of good managers there. So yeah, I think for retail investors, they're a good vehicle, and particularly what they're good for is actually more illiquid asset classes. So we've had problems within unit trusts, particularly in the property fund space, because unit trusts basically offer daily dealing to investors, so buying and selling units in the fund. Well, if you think about kind of the idea of holding commercial property in a fund like that, it's quite difficult to kind of buy and sell whole commercial properties like a shopping estate in a day. So it just doesn't happen. So there's a bit of a mismatch there between unit trusts and illiquid assets, whereas with investment trusts, they're a fixed pool of capital. So there's no new money going in. People buy and sell shares off each other. And so the fund managers doesn't have this kind of worry, which is like, oh, well, I've seen X million pounds of outflows today. I have to go sell an office block, which is difficult, right? Mm-hmm. So for more liquid assets, I think investment trusts really come into their own.
Okay, wow. Just final thought, Cherry, what would be your top tips for those who are thinking about getting going in this new tax year?
I would say, don't overcomplicate it. I mean, we talked about the importance of staying invested. So just finding something you're comfortable with, that's diversified, that just sort of gets you in the market, that should be a priority, really.
Okay, well, on that note, a very big thank you to our guests, Cherry Reynard and Laith Khalaf, and to our sponsors, Asset Value Investors. If you would like to learn more about them, then please go to their website, assetvalueinvestors.com. Or if you've got any questions for me, please email me at marcus@stepstoinvesting.com. Until next time, goodbye.